Steve, stay right there as we bring in Paul McCulley, PIMCO's former chief economist. Paul, always like to speak with you on the eve of these decisions. And so far, the preponderance of evidence has kind of been to the deflationary side of the tariff case. I mean, even, let's see, apparel prices slightly lower. There's not a lot in any of the reports up until now that point towards a lot of price hikes throughout the economy. I guess, Paul, we'll have to just see what the next couple of months bring.
I think that's right. But the bottom line is the most recent data has not been stagflationary, but actually a continuation of a soft landing. And I think that is very good news. Now, I think I agree with the consensus from Steve's survey that the tariffs will have a stagflationary impulse. And that it will be delayed because it's in goods and we're working off the non-tariff good inventories now. But fundamentally, I think that the economy was in a really good place to take the stagflationary shock. And the Fed was in a really good place at the restrictive side. So I don't think we should get too wrapped around the axle of negativity right now. I think we will absorb this.
Steve, jump in here.
Well, I will say there was some evidence of tariffs in the recent inflation reports. For example, you had appliances up. There were a bunch of commodity goods that did indeed go up. The import price data from this morning does suggest that the exporters are not absorbing it. And plus, Kelly, you did have $70 billion of tariffs collected. Somebody paid that. I think the story might be that you did have some disinflation in other parts of the economy. And now, of course, one of the worries might be what happens with oil prices in that they're not going down anymore. They may not be offsetting it. I think the idea, I like this 4 to 3 outlook on whether or not these tariffs end up being something that's a one-off thing or end up being something that causes a broader inflation. It's a good division there. I don't think anybody has the gospel on that particular answer, Kelly. And so I think that is more and more reason for the Fed to wait and see. Despite the pressure from the president to cut, I think the Fed wants to be very careful that it's not cutting into a bigger inflation problem.
Understood. But, Paul, are they being too careful? You know, because it's like they say, well, we're erring on the side of caution by not doing anything. Well, but by not doing anything, that's still kind of a pretty big move, for lack of a better word.
They're being cautious, but I think righteously so. And I think the downside is pretty small of them being in this wait and see, because if the data start coming in very clearly that stagnation or worse is dominating the landscape, the financial markets will price in easing long before the Fed actually delivers it. So I think the Fed has an insurance policy against this charge of being behind the curve. By definition, they will be behind the curve when they operate with forward guidance telling you what their reaction function is. And then when the data come in saying by their reaction function, they should be easing, the markets will very vigorously front run it and ease financial conditions and therefore provide support to aggregate demand in the economy. So I think we should be really, really careful about this charge of behind the curve, because you have a release valve on that. Is they're so incredibly transparent that essentially they give the market the freedom to effectively righteously front run them.